We have some big news to report with both Microsoft and CrowdStrike shares falling in the pre-market due to a major outage with businesses globally being affected. We can in fact see that when we look at numerous reports, there are a lot of chaos right now around the world. We have this affecting major banks, media outlets, and airlines, among many other businesses. And in fact, when we do take a look at the main source of the issue, it does seem to be with CrowdStrike and around the Falcon sensor update, which has ultimately affected significant issues right across the world. Now, how does this affect the company itself? Well, we can see in the pre-market, CrowdStrike holdings are down around 14.5%. Bear in mind, they have fallen as much as 20% in the pre-market, and today we're going to run through whether or not this is now a great opportunity to buy a very rapid growing company. Now we're going to take a look, few things to bear in mind as we go along, whether or not you do believe that trust is lost with some of their customers, as ultimately they do have some very fantastic recurring revenues as they are part of a subscription-based model. So first we're going to go straight into the valuation piece so you can understand where we're starting from, and the intrinsic value in today's episode is coming to $366. Now the current trading price of $290, as we already mentioned, it is the pre-market and it has gone down a lot lower to around $275. From right now's price though, Wall Street do have upside of 39%, a $403 price target. Bear in mind though, this may change after the news today completely unfolds. And where we got our intrinsic value of $366, we run it through the DCF model where we have the free cash flow year on year. We see some incredible growth at 390%. As you'll see later on in the episode, we're going to break down all of their metrics. And with the discount rate, we do get the present value of future free cash flows and terminal value. Now we are using a 25% growth rate, which we do believe to be a medium rate. We also have a low and a high. We then add all of the free cash flows together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, that intrinsic value of 366. Now, for those that do believe that is too optimistic, we do have that 20% there, which does imply downside of 9%, our medium rate implying upside of 26, and a 30%, a very large upside of 74. Now, as always, you can grab a copy of this model by clicking on the pinned comment below, putting in whatever growth rate you believe, whether in fact you believe it should be much lower at 15%, we then get an overvaluation signal, or if you believe it to be higher at say 35, again, it will give you a different value. But as we mentioned, we are using that 25% rate, which we do take through to the intrinsic value. And what we always like to do on this channel is use a margin of safety. So at 10%, we would say this would be used if the company meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, it looks to be a buy up to around $330, then we keep going till it's near the current trading price, and we see it right now at around 20% MOS, price target around $293. Whether or not that is sufficient for you to execute on this company that has had a very large issue reported today, again, that is something we can consider throughout the episode. But as we said, it is in the pre-market now, so it could go a lot lower, but it could also recover as it has started done just over the last few minutes. Now, going back to the company itself, we do get a strong buy rating from Wall Street, a buy from Seeking Alpha with a hold from Quant. Now, when it does finally open in the pre-market, it will be trading somewhere in the region of the midpoint of the 52-week range. And over the last 5 years, we can see it is up 372%, phenomenal performance, and would have significantly outperformed the S&P during that period. Now, in terms of some of the metrics, the first one we're looking at is the free cash flow. What we like to see is increasing over time. This is a very good indication of a high quality company. It did have negative free cash flows, but since 2020, where it turned positive, every single year it has been consistently increasing in the right direction, anticipated to continue that trend over the next 12 months. In terms of sales growth, well, 2 things to consider. Firstly, fantastic growth over the last 10 years. Second thing to consider is that it has been reducing, and even though it has some very strong double-digit growth in 2024 at 36%, you may want to ask the question whether or not you believe it will continue in that downtrend and start to slow down quite significantly. We then look at the total sales. Well, phenomenal. It has been increasing at a very rapid rate, as we just saw above. And the other thing to point out is that they would have diluted your position if you have been a shareholder over the last 10 years. As always, we prefer it when companies do those share buybacks, returning excess cash to our pockets. Now, one thing to note with ROIC, as we will come to look at on the financial statements, they did not turn a profit for the majority of the last 10 years, hence why we are getting negative ROIC. On a trailing 12-month basis, though, we do get that 1%, something to consider, but we will highlight that very soon. And again, we can see that based on the operating margin, although nice to note that it has gone from a large negative 172 all the way down to around 0 in 2024. So hopefully with the rapid increase we are seeing in their top line, we can start to see those margins increase and become incredibly profitable. Free cash flow margin as well, looking very, very good over the last 4 years. In the low 30s, that is an incredible number. So hopefully if that does continue, we can end up classifying this as a free cash flow machine. Net debt to EBITDA, well, the earnings before the interest, tax, depreciation, amortization, shows us the strength of the balance sheet. Now, these numbers show us the number of years it would take the company to pay off all of their debt net of cash on hand. 0 over the last 4 years, 0 over the next 12 months, effectively showing us it wouldn't even take this company 1 day to pay off all of their debt net of cash on hand. So that is great to see about CrowdStrike Holdings. We then take a look at insider ownership. Now, it sits at just above 4%. We see around 243 million worth of insider selling over the last year. No insider buys. But in fact, this is a common theme that we have seen over the last few years, so no surprise at all. Every quarter, there does seem to be a fair amount of insider selling. Now, for those that do want to see who these insiders are, well, the more recent one, we get the insider Sean Henry on the 15th of July. We also have a director at the beginning of July and another one at the end of June, selling a fair amount of shares, as we can see the amounts here. But as always, we don't see particularly insider selling as a bearish signal. Insiders do sell for many, many reasons, whether it's personal or financial, so not something we consider, but for transparency, we have shown it today. In terms of institutional ownership, just above 71%, 3 billion worth of sales by the institution over the last year, but we see a lot more buying, in fact 9.4 billion to be exact over the same time period. And when we do look at the more recent quarter, we do see a marginal more selling than buying by institutions, and that is also shown in the previous quarter. So in summary, yes, insiders are continuing to sell, and institutions over the last few quarters have been selling more than they have been buying, whereas overall they have been buying a lot more. So what we would say here is to always do your own due diligence and never copy insiders or these institutions. Now, we want to take a look at their Q1 results at a very high level that they released not too long ago. And some of the key highlights to point out is, in terms of their revenues, we are seeing their ARR, which is their annual recurring revenue, up 33% year on year, as well as a lot of new annual recurring revenues up 22%. As always, what do we like to see on this channel? Not just increase to the top line revenue, but also their margins. Year on year, they are up 5 percentage points on the operating margin. Always a great sign. Earnings per share up double digit, very strong, which we will come on to look in more detail shortly. And their free cash flows, as we mentioned, very important for us as investors. That is up a whopping 42% year on year. Then when we take a look in comparison to the same quarter from a year ago, we can see 33% year on year growth on their annual recurring revenue. As we mentioned as well, the same to be applied there with their new annual recurring revenue looking very healthy, and both their subscription and total revenue up double digits right across the board. This is a very good company in terms of its growth, but a few things to bear in mind. As we did see over the last 10 years, that growth has started to slow down, and in today's episode you will also need to consider the news that we did discuss at the beginning, whether or not you think that will impact their revenue, their customers, their recurring revenue moving forwards. Then we take a look at their gross profit. Well, that has also increased, no surprises, but we like to see that their margin here has at least stayed the same rather than reducing. Again, ideally, we would like to see this increase as well. Operating income, well, that margin has gone up very nicely, as we saw 5 percentage points, and their earnings per share as well as free cash flow showing some very strong movements into the following year. In terms of their guidance as well, they are looking for pretty much around 4 billion for the full year of 2025. Again, we will take a look at their total revenue over the last 10 years to compare how strong that is. And again, we can see some very good numbers here, around $4 on the net income per share as well. Finally, just a few things to understand. This is what they call their target operating model. These are the numbers they do hope to hit over the longer term. Now, in terms of looking at this company, their total revenues, their total net incomes year on year, just to get a better picture of where this company has been historically, we can see 53 million reported in January 2017, latest annual accounts 3.1 billion, and as we did see just not too long ago, in fact, they are hoping for the full year of FY25 around 4 billion. So that is some massive growth from just the previous year of 3.1 billion, and we can see as well that top line revenue looking very healthy in terms of that constant increases year on year, something we do hope they can continue with into the future. Not only that, but as we can see graphically, for the majority of the last 10 years, bar the more recent year, they were in fact turning a net loss, so hopefully they can turn this around. As we said, other metrics are looking very strong. Revenue is increasing at a very rapid rate, as well as their margins not only being maintained on the gross margin side, but the operating margin looking very healthy with that 5 percentage point increase. We then move on to the health of the company, and as we already ascertained to, we can in fact see that they do have a very strong balance sheet. As we do total cash versus total debt, 34 million of cash in 2017, 3.7 billion in their latest quarterly report, so similar to their revenue that has been increasing, so has their cash. And when we compare that 3.7 billion in their cash against their total debt, which is what we always like to do, otherwise on its own it is meaningless, we can see that it's gone from 24.5 million to 793. So yes, it has increased, as we can see, but when we compare that to their total cash, their cash can pay off all of their debt in one day if they wanted to, so a very strong balance sheet. We then move on to their earnings per share. How have they done historically? What is the expectation moving forwards? Well, look, over the last 4 quarters, they have beaten, always a great sign, 100% track record, so that is something we do quite like to see. It will give us faith when we look at their predictions moving forwards, and we can see double-digit growth anticipated for the EPS year on year over the next 4 quarters, and if they do hit that EPS estimate they're hoping for in January 2026, then by that account their forward PE will drop down to around 69.58. Bear in mind though, these haven't updated for the pre-market numbers, so we will expect the forward P right now to drop drastically given that share price drop as well. But again, let's see what happens when the market does open. In terms of their gradings, well, I don't think this will change much even after their drop. They do get an F grade. Now, one of the reasons for this on a P non-gap at the previous price, it sits at 85 versus the sector median a lot lower at 25. So in fact, you are paying a significant premium, 246% to be exact, and that is pretty much right across any valuation metric that you use. So again, if you do believe that it is warranted that this company is a high quality company, we can in fact see against the sector it is significantly higher. Now, how does that compare to other metrics? So for example, on the growth, they get an A. Year-on-year revenue, 35%, a lot better than the sector median, low single digit. Same to be said moving forwards into the next year. Sector median at mid-single digit isn't looking great. Again, one of the reasons why we do see this valued at a premium. And one thing we love to see, which is actually incredible for CrowdStrike, 40.2% is what they expect the earnings per share to increase over the next 3 to 5 years. When we do take a look at the sector median, 14%, so significantly better. But again, is it worth the premium or not? That is something we did take a look at when we saw the valuation, but you will need to come to your own conclusion and look at your own investment thesis. In terms of profitability, well, they also get an A. In terms of gross profit margin, 75%, sector median around 49%. Bottom line as well, 4%, marginally better than the sector at 3%, but we do believe this will be higher as the years do progress. As we did see earlier, they did turn from a massive net loss, progress to a small profit, and hopefully we will anticipate that to increase given the increases we are seeing in their recurring revenue as well as those new customers. Finally, cash from operations, well, 1.25 billion. We can in fact see the sector median much lower at 99 million. So in conclusion, for this part of the analysis, a buy from Seeking Alpha, a strong buy from Wall Street with a hold from Quant, an F on valuation, A- on growth, and an A on profitability. Now, how have they performed against others in the industry? So we are looking at the system software. We have Palo Alto Networks, Fortinet, Zscaler, some very big companies. In fact, we have reviewed every single one of those. And when we look over the last year, bear in mind this doesn't include the pre-market drop. Still do believe it will be significantly high. 124% then over the last 12 months. No other company comes anywhere near. Over the last 5 years, again, we can see very strong 372%, coming in at second place, Palo Alto Networks. But again, after today's drop, these two could turn around. Regardless, the point here is that they are a very strong company historically, but as always, the past performance is not an indicator of future performance. The next thing we want to point out is that we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment below and you can start reading straight away. Also, to let you know, the 18 undervalued dividend kings comes with a free spreadsheet running through some very undervalued companies and some price targets. Now, finally, we just want to leave you with this thought. Given the issues surrounding today, you may be more inclined to look at the S&P 500 ETF, low cost expense. But what we will say is that over the last few years, it has outperformed the S&P 500, CrowdStrike up 124%, and over the last 5 years, we can see again significant outperformance. As always though, you will need to question, do you believe they will be able to continue to outperform over the next 5, 10, 15, 20 years, depending on your investment horizon? As always, if you enjoyed today's episode, smash that like button, hit that subscribe button, let us know your thoughts in the comments below, and we will just run through again our valuation. We get to an intrinsic value of $366, a 20% margin of safety, upside from Wall Street of 39%, and remember this was all derived from our growth rate of around 25%. As always, we'll see you all on the next one.